You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert Tom K. Wilson. Now, Tom began building his personal real estate portfolio back in the 70s by first investing as a part-time activity before deciding to hang up his corporate gloves, managing manufacturing and engineering operations in some of Silicon Valley's pioneering technology companies, and then moving into becoming a full-time real estate investor. Now, Tom has bought and sold more than 4,000 units and over $500 million worth of real estate throughout his years, including a variety of commercial, residential, and multifamily properties. Now, guys, before we get on to the show with Tom here, I just got a couple laundry list items I want to run through with you. Actually, just one. So it's going to be a quick one today. Our company, Sunrise Capital Investors, we're based here in Clearwater, Florida. We're looking for some really talented folks to join our team. We have a number of different positions that are open here at our firm. If you have an interest in seeing what we're all about, seeing if you might be a good fit, seeing if the positions that we have open could be a good fit for your talent, we love to hear from you. You can learn more about those openings by going to careers.sunrisecapitalinvestors.com. Again, careers.sunrisecapitalinvestors.com. Okay, guys, so I'm very excited to get onto the show with Tom. But before we do, here's a quick word from our show sponsor, Sunrise Capital Investors. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I'd like to leave with one last thought. From the time that I wake up in the morning to the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Okay, now without further ado, I'd like to welcome Tom K. Wilson to the show. Tom, how are you doing today?
Doing great. I can't remember the last day in a while that I was not a great day.
Yeah, well, that's fantastic. I like to hear that. And you're out in sunny California, so right, the weather's got to be amazing here today, I'm assuming, right?
It is. It's but you know, wherever I am, Kevin, it's a beautiful day to me.
Oh, fantastic, Tom. Well, I'm real excited to have you here on the show and have you join us. You've been at this game for many, many years now. The 70s, you've seen a lot. I mean, you've been through multiple ups and downs. I really want to get a sense of what your background looks like before we dig into the meat and potatoes of your business itself. Take a few minutes, if you would, and tell us a little more about you.
Well, thank you, Kevin, and thank you for having me on the program. I always love sharing my experiences with others and hoping that they can have a little faster track to successes. And I did by learning the hard way and having a few failures along the way, but it's all what matters is what you do next and capitalize on things that you've learned. Mm-hmm. I was born and raised in Virginia, got a AA degree in electrical engineering in University of Delaware. I had a bride of 1 year who was a nurse. I sat there one evening and said, "Sweetie, what do you think about going to California? I'm hearing that there's a lot of electronics emerging out there. It could be an exciting place to go, and there's a lot of like-minded people." She paused for a moment. She said, "Okay." So we got offers from Fairchild, Hewlett-Packard, and Varian. I picked Fairchild. 8 became, and my first property that I leased was next door to the landlord. And the landlord I found owned half the street. He had no college education. He was in his late 30s, and he was financially independent. That's what you call an aha moment. So against better advice, many folks said, my gosh, buying real estate here, the price had gone up so much in the 50s and 60s, I couldn't imagine it go up anymore. This is 1969. So I took a big risk, another big risk, and started buying houses. So after 30 years of high tech and 2 startup companies that did not fail, 9 out of 10 don't make it, contrary to popular opinion, yet this is the place where there's more success in startups than any place in the world. Mm-hmm. So but it's hard. So after 30 years, it was fun. I learned a lot, but I woke up one day and realized, my gosh, my real estate I bought in the 70s is contributing more to my retirement than my day job and stock options are. So I'd always loved it. Basically switched careers, realized that California, any high-end city in the country, by then didn't cash flow worth a darn. So I studied the country, and Texas came out on top. I started selling properties in California and then exchanged them into portfolio down there in Dallas, Fort Worth area, getting associated with some of the clubs in our area. And I had a lot of folks say, "Gosh, Tom, this makes a lot of sense to me, but I don't have the time or the knowledge. Could I buy from you?" So I started putting together a little business plan and put out a website for that. And little did I know that 15 years downstream, I'd be doing $50 to $100 million a year worth of commercial real estate.
Well, that's fantastic. And I want to get some more clarity as to what that transitional period looked like, going from corporate America. Obviously, you part-timing the real estate side of things. And right. Did that typically mean residential investments? I mean, you were buying, single family properties as rentals, or were you already dabbling in the commercial realm?
No, well, I was doing it part-time. It was all houses. So it was all houses in what became Silicon Valley. But, I found out that, I sold one median price house at that time. It's probably $450,000. This would be year like 2000, 1,300 square feet, standard 3-2 bath house. I sold it and I exchanged it into a 68 unit apartment house in Fort Worth that spun off $50,000 a year. And now that same property spins off $100,000 a year. Mm-hmm. So it's kind of funny. A lot of people said, "Oh my gosh, Tom, I bet you're so sorry you sold in 2000, 99, 2000, so forth, since properties went up so much." I said, "Well, that $450K house today is worth probably a little over $1 million. But that property, as this one example, the multifam down there in Dallas, I bought for $1.45 million. And I have it on the market today for $5.1 million. It's been spending off $50,000 to $100,000 a year.
I'd say you made the right decision there.
So no, I'm not sorry. I was okay.
Yeah, fantastic. So I want to talk about the transitional period now, going from a single family to commercial real estate or multifamily. And I kind of lump multifamily into that commercial realm. Okay. So when I say commercial, multifamily is classified in there as well. It's obviously a big difference buying a single family property that's typically valued on the comparative sales basis to buying a income producing, whether it be multifamily or commercial. Again, commercial is the general term we're going to use today. So talk to me about that transitional period to where you started, you were searching in Texas, you were seeing opportunities there. You had a lot of people that wanted to invest with you, but did you go ahead and create yourself a track record first in the commercial side of things prior to actually taking outside investments? And what did that first commercial property actually look like? What was it?
My first property, my first commercial property was a 68-unit multifam that I just described. And that was in the year 2000. So I wound up buying 9 different multifams over that period of time for myself. So what happened was I was exchanging mostly into 1-to-4s, singles, duplexes, triplexes, fourplexes, building up that portfolio, not having the intent to go into something larger. I didn't realize I could go into something larger. It's people kind of think they have to take these baby steps, and as I know now, you don't. Right? You can just jump ahead and accelerate a lot faster. But the first in 2001, I bought my first condo conversion project, 51 unit townhomes, and looked like to me it's pretty easy to just show the residents who were there that it was cheaper for them to own than buy. But I found it was difficult. It's just a mindset. It's more than what the numbers work out to be. It's just kind of a mindset. A lot of renters will always be renters. And so I thought, well, shoot, the numbers work. I'll come back to my associates and folks back here in California, show them the numbers, and maybe they'll buy them. They did. They bought the whole thing out. So that was my first kind of paradigm test, a beta test, that there was a market here for folks that would like to buy properties at cash flow who were trying to make it cash flow here in California, where it didn't make sense anymore. So that's when we launched a separate business that also provided initially just houses. We provided 650 turnkey houses to investors in California by buying foreclosures, having our management company fix them up, put tenants in them, and property management in place. So we did 650 of those over the course of 10 years. Meanwhile, I was building up my own portfolio of multifam, did do some syndication investing in commercial and non-multifam commercial. And then long about 5 years ago, my favorite broker down there in Fort Worth said, Tom, I think the residential market's getting overheated. It's really hard to find margins. People are buying. We're still competing with hedge funds, and it's just getting very difficult. But he said the non-multifam commercial, I think, still got a window of opportunity here. Do you think you could raise money for it? I said, I think we can. Well, let's start off easy and give it a try. So we did a $3 million retail strip center, raised that in a hurry. And here we are 3.5 years later, taking down a $55 million Class B multifam in Atlanta. So it's grown very fast. We've got a phenomenal team, and we love all the assets classes: industrial, office, retail, multifam. This multifam is very, very hard to get the same returns these days because there's too much demand relative to supply. I think a lot of folks have this natural mental progression that if I have houses, then I think I understand multifam, even though they don't realize how many more moving parts there are in a multifam property.
Yeah,
but it's harder for them to have a paradigm jump to this commercial, say a industrial building, has metal sides, no windows, can't tell what's going on inside, and just feel comfortable with that, right? So it turns out in this day and age, that's a lot better deal in most cases.
Let's talk about that a little bit. I'm a big proponent of focus, and now I've owned larger multifamily apartment complexes. I've owned hundreds of single-family rental properties. For the last 5 years, we've solely focused on manufactured housing communities, and I've owned bits and pieces of other type of commercial real estate throughout the years. But I've always tended to focus, and that works well for me. I do better with blinders on than to put my fingers in a bunch of different pots, meaning like I'll buy some industrial property here, a couple assisted living facilities over here, and I like all those asset classes. I like retail. I like all of commercial real estate. But I want to hear it from you as far as, did you find it challenging to with that diversification? The first, it sounds like non-residential, non-multifamily property purchase was a industrial property, I believe. No, I'm sorry, it was a retail shopping center, correct?
Correct.
Yes. Talk to me about that change of mindset there. It's a different, it's got some of the same fundamentals, but it is a completely different business.
It is.
The economics are completely different.
Absolutely.
Supply and demand factors are completely different that are tied to it. So talk to me about that transitional phase for you, going from multifamily over to retail, and then literally jumping from that to industrial. And then I see on your website, you've got some assisted living projects going on. You've got some ground up land developments, office buildings. You've got a little bit of everything. So I'd love to hear from your perspective, what that diversification really looks like and how someone can achieve that comfortably.
A few years ago, someone asked me, Tom, you've clearly had tremendous amount of success. What would you say is a common denominator for that success? And no one asked me that before, and I thought about it, and I said, by having outstanding partners. And he said, I would say exactly the same thing from my experience. Mm-hmm. I don't do any investment without having experts in every aspect of that deal. So in our syndication business, the main thing that we bring to the table is access to investors, clients who have seen our track record, like our integrity, like our transparency and genuineness, and they trust us. That's the main reason that they invest with us. So we do that. We service the customer. We distribute quarterly funds that go out along with the reports. But if we, let's take, for example, I thought I'd never buy another property in California, but from a development standpoint or entitlement, because it's so difficult in California, that it turns out that there's some value there. Trying to buy a property in California or New York or any other high-end city where it's stabilized and make cash flow, it's going to be roughly half of what it is in a Dallas or a Orlando or Atlanta, places like that. However, development does have what we call a lift, right? You can provide value add by doing that. So we've got a couple of properties that are assisted living. So you think, well, assisted living is kind of like residential. Well, not really. So what are the components? We have a land guy who's an expert in that. So we bought an infill piece of property. He's an expert in entitlement. He's been doing that for 30 years where he can get the permits for it. It can take from 1 to 3 years to do that in California. Then we need, for assisted living, we need someone who's an expert in designing assisted living, someone who's an expert in building assisted living. We need someone who's an expert in operating assisted living. So we have an expert in every one of those aspects on our team for the assisted living facility. So what I'm doing is getting the synergistic value of putting together a team that has the expertise. And could I maybe pull it off on my own? But it's putting my clients at a higher risk. It's putting me at a higher risk. I'd always rather take a smaller piece of the pie and minimize the risk for myself and my investors and maximize the returns.
Mm-hmm. Is it pretty common that some of these other projects that you're involved in, when it's brought to you by a broker, assuming that broker is an expert in that given marketplace and in that actual asset class, that you might bring the broker in as well as kind of more boots in the ground as a partner?
Yeah, we aren't dealing with brokers per se. We start off, people say, well, Tom, how do you know what you're going to get? Do you pick the market first? Do you pick the asset class? And I say, again, the most important part of, I think, any success is outstanding partners. So we have partners around the country who happen to be brokers, but they primarily are experts in co-syndicating fine products that are good to syndicate. They aren't primarily working as a traditional agent who's just representing buyers and sellers living property. They are co-syndicators. So we have several of those that we are close with, have close partnerships with, strategic relationships with, and these are ones that have been in the business for a long time. They have high volume of deal flow. We have one broker that gets over 300 deals a day across his desk. Now, Obviously, you can't look at all those. Most of them are rejected, and he has a staff that helps him with that. But if somebody thinks they can just walk into some broker's office and take the first person and say, I want to buy a multifam, or I want to buy this or that, and think they're going to get a great deal, it's just not going to happen. So we filter through Wilson Investment Properties and filters through hundreds and hundreds of properties to find ones that are worth taking a closer look at. And then we do a first modeling of that. And if it passes that test, then we start doing more serious underwriting. And you got to keep checking along the way, see if it's still available. I'd say a third of our deals are brought to us off market, or that the first buyer fell out, and then they come back to us, and we have a reputation of closing and being professional and being easy to work with. So, as you go along, now we have most of our deals being brought to us. We don't have to go look for deals.
Okay.
And we can say no. Excuse me. One other thing I've told to tell my team all the time is our long-term success is dependent more on what we say no to than what we say yes.
Absolutely. Always try to find a way to kill a deal, right?
Yep.
So your internal team, as far as like deals coming in, filtering them out and kind of giving them the first blush financial model or first underwrite, is that you that does that, or do you have someone on your team that's all they do is filter out these deals? And I know that your partner level probably does the initial filtering. They have a general idea of what your criteria looks like. Once it passes their first snuff, they pass it on to your team. What does your team look like internally?
So I have a COO who specializes in the underwriting and analyzing the deal flow. I'm kind of the risk manager that stays in the back room and asks the tough questions. I've watched 5 cycles. They've read about it, but they don't feel it in their belly, right? So
right, exactly.
So I'm the risk manager, and then I still I'm part of the kernel in front of the chicken, the guy that still puts a face to the company. Although I'm working toward letting the public get to see their faces more, so they don't. If the wizard's missing, they don't think like the company's gone. Mm-hmm. Yeah, so I'm doing the risk management, kind of the veto guy. I'm the one that says, "Now, are you sure you've got this underwritten conservative enough that it can survive the next recession? Because all expansions end. We don't know when it's going to end, but they all end, and we'll probably have to ride through that. So make sure we've got enough meat on the bone here that we can survive that. So no, we have a guy, our CEO, is a specialist in getting and analyzing the deals. Our different partners have different skill levels. Yes, most partners can do a first cut on the pro forma. Some of them can do extensive underwriting, but we always, when we get down to that level, we put the underwriting spreadsheet, which is typically hundreds or thousands of cells with all the assumptions and the IRR and all the distributions. We usually put that on a Google Doc spreadsheet, and then they will spend literally hours on the phone looking at that spreadsheet and discussing what we think is reasonable. It's that's a really tough part of the business. That's part of the art. You can't. That's not something you can read about in a book. You got to know. You got to make reasonable assumptions. You always want to overperform of what you promise your investors. But if you took worst case, you'd never buy anything. So it's a delicate balance.
Sure. No, absolutely. Now, you've taken many years now to develop these strategic partnerships with these different folks across the country. What advice would you give someone that's that not necessarily just getting their feet wet, but let's say that they were where you were, 35 years ago, where they own some residential properties, maybe some small multifamily, but they're looking to play the bigger game. They're looking to get into some larger syndications. They're open-minded to the different types of asset classes that are out there. They're not really set on just one. But as far as building those strategic relationships in multiple different markets, what would you advise someone? Where to even start with that?
I wish I'd known about, or they had existed more when I started. They were, there's always been REITs. But REITs are a blind fund, and it's something you can get in and out of quickly. So it more rides up and down with the market. We're more of a boutique syndicator where investors get to choose which products, which markets they want to invest in and which ones they don't, and then kind of build up their own real estate mutual fund by deciding what to invest in, which syndicators to invest with. I would say learn enough, like listening to your podcast or your listeners, learn enough to be able to ask smart questions. But don't try to reinvent the wheel. I got good advice early on in technology business that I was in, high tech here in Silicon Valley. Most techies like to hang in there and stay micromanaged in every little detail. Mm-hmm. I think techies make good investors because they are analytical and they don't let the emotions usually get in the way. However, we can hang in there too long and analyze to death and never buy anything. I would advise most people, don't feel like you got to own. If you're investing and buying private shares and syndications, you're totally passive. You have no liability, and you can distribute your investments in different places. So you need to learn enough to ask questions to the potential syndicator and syndicators and decide which ones you want to go with. Most of our clients say, when you ask them, why did you invest in this? Is it because you were sold on the idea of industrial, or you really liked the Charlotte metro market? And they invariably will say, well, the main reason we invested was because we trust you.
Mm-hmm. Sure.
So, So that's now, if someone is dedicated to just got to do it themselves, find somebody that you can partner with, and maybe you got to be able to bring something to the table, right? If you're doing that, you got to be able to bring the ability to fine product, or maybe you're bringing money to the table, or maybe you've got work ethic and you can do a certain portion of the work that's needed. Kind of hard to get started. You really got to partner and find something that you can, some skill set that you have, or money or something that you can bring to the table that makes them want to partner with you. Right? So it's not all about about what you get out of it. It's what you can give the partnership.
Absolutely. And I feel that my personal opinion to that would be learn how to actually identify a good opportunity and learn how to properly underwrite whatever type of asset you're going to be going after. Like if there's any value you can bring to the equation, at least in today's real estate cycle, would be quality deal flow. And it sounds like you've got plenty of that, but most people don't. And I think
most people don't. No.
Yeah, like in today's world, raising capital is a little easier than it is finding quality deal flow. I mean, that was slightly different in 2010. Capital was a little bit more limited, but there was an abundance of deals, right? There was a lot of blood in the street at that point in time.
Yeah,
and so
that's a tough part too. We have a client base of 16,000. So how long does it take to build that up? Do you need 16,000? No, but you need some percent of that. And
sure.
It takes, like any business, right? It takes all the legs of the stool. You got to be able to qualify for loans. You got to be able to have the deal flow. You got to have the expertise to know how to negotiate it and do the due diligence, to be able to manage it, to bring in the equity, to get the loan money, to qualify for the loan. It's a lot of legs of the stool.
Yeah.
And to underwrite, you got to have the expertise to underwrite it. Not talking about that little pro forma thing you see on the flyer sheet. We're talking about typically this underwriting is typically thousands of cells, literally, to do it well.
Would it be a good use of someone's time to actually go through the CCIM classes? Do you think that's a good way to spend time and energy and money for someone that's looking to dive deeper into this space?
It's a high quality education. I haven't been myself, but our CEO is going, and several of our partners are CCIM members. So I think it's, I think if you're going to be doing it full time and you're trying to build up your own business, then I think it's very valuable. But I don't think for the typical investor, I don't think it's a necessary or good ROI.
Okay.
I don't think you need. I think they can get a lot better ROI by listening to your podcast and my podcast and things like that. That will get much more efficient for the things they need to know. They don't need to know as much detail as you get in a CCIM classes.
Good point.
It's my impression.
Good point.
Yep.
I want to talk a little bit about, this is something I just learned of right before we jumped on this call, was your meetup group. You actually host a commercial and multifamily, I don't know if it's weekly or monthly meetup there in the Bay Area.
Yeah.
I spent some time looking at some of the past meetups, and it seems like you get some great guest speakers there. You guys cover some amazing topics. Tell us a little bit more about that. But, tell us a little more about it. So for those that are based in the Bay Area, they might find some interest in attending one of your meetings. But in addition to that, I'd love to hear from you what kind of value this has brought your organization by, creating this local entity and this gathering of just brains in one room on a monthly basis. I'm sure there's some value that's brought to your business. So in any event, tell us about the group and then also what kind of value it's brought to you over the last year or so.
Thank you, Kevin. Well, it's BACOM, BACOMM.club, Bay Area Commercial and Multifam.club. I love education. I love sharing with others what I've learned. I'm not of scarcity mentality. Maybe if you're an Apple or a Google or Amazon, you've got to be more guarded. But, there's a lot of folks in this space, and I've never exchanged ideas with someone like you that I haven't felt like we both came out with something beneficial that we could maybe apply to our businesses to make us better and make our businesses better and those who associate with us be better. So I'm a member of 3 RIAs in the Northern California, one of them for 15 years, and been a strong sponsor and have helped MC or bring some components to each of it, to some of them. As this syndication business with Wilson Investment Properties took off, we realized that most of these RIAs in the country are still focused on houses, right? And we're focused on commercial and multifam properties. We felt there was a need. There's no other group in Northern California that was focused on commercial and syndication product. And we certainly realized there's probably a smaller percent of total investors who are willing to take that leap of faith or to try that arena that's getting outside of their comfort zone. But we thought it was worth a try. So my director of marketing came to me about a little over a year ago and said, "Tom, I know you're really wanting to have your own education event. And I know it takes a lot of work and you need somebody to lead it. He says, I think you should do it and I'll lead it. And I said, well, you go, Jen. so, it's for someone attending, it seems like, well, it's nice. I showed up and this speaker and I met some folks and went home. But oh my gosh, the amount of work that goes into it, finding the venue and the AV team and getting the volunteers and marketing it and getting the right speakers and all of that is just a tremendous, tremendous amount of work. Within 4 months, we had the largest audience of any RIA event in 10 years. And,
wow. And what does that mean? How many folks?
300.
Wow. That's a big number.
So we're getting some speakers, and there's some places in the country that are able to draw that on occasion, but not very much. For that event, we had my good friend, Dr. Doug Duncan, who's the executive VP and vice president of Fannie Mae, the largest lender in the world. Mm-hmm. So I've known Doug for 11 years now, and he's gracious enough in his 100 speaking event tour of the year to include us and come out and talk to us. Mm-hmm. So part of that's friendship connection. The other part is he's one of those great guys, untypical on Capitol Hill, that really wants to know what's going on out there on Main Street in the real world. So he loves interfacing with folks to find out, how do you feel about what's going on?
And I brought up the question about this meetup group, Tom, because I'm a big proponent of folks positioning themselves as the thought leader, and they don't have to be even the expert in that space, but facilitating a meetup group like this, the amount of value that it could bring to one's business and helping them grow their business and their overall network is gigantic. And it's a lot of work. It's a lot of effort. But I ask you, I guess, as far as what types of benefits have you seen from it? I mean, as far as your own general knowledge, I mean, you're better off because of it now, because of some of the great speakers you've had there. I'm sure that you probably built some great friendships. You probably expanded your own personal network of investors, right? I'm sure there's a lot of value that this has brought to you just over the short period of time that you've been doing it.
There was a very successful apartment store chain by the name of Wanamakers in the Northeast. You're probably familiar with it.
I remember. Mm-hmm.
Yep. John Wanamaker once said a famous quote, I know that half of all my advertising and branding is worthless. I just don't know which half.
So very true.
So it's hard to tell. I think when you get to have a larger business, there's just a lot of things that you can do to help extend the brand. You're never sure which one brings somebody in, but I think it's having exposure to you in many different areas where you build up credibility. Maybe it's even subconscious. I'd say half the calls we get from new prospects, they say, Tom, we've been following you for years. By the way, we heard you speak at such and such event. By the way, we love your radio show. and we've known we needed to do something. We were working our buns off here as two professionals, stashing away money and sitting in the bank. We really like the idea of real estate, and you've got a great track record, and we just thought it was time to talk to you. That's over half our calls, just like that. Now, so which one was brought in because of they saw us at Baycom? Which one was brought in because they heard our radio show and podcast? It's hard to, sometimes it's hard. They don't even remember what it is. But I would say to jump to the bottom line, if your question is, certainly it continues to help us just like the podcast does. It helps continue to build relationships with those who are guests and speakers. We meet new people. Every time we have a meeting, you ask how many are new, and you get maybe 20% of the hands go up that haven't been there before. So you add to your client community. And we've had people come up to us afterwards saying, just voluntarily saying, I want to thank you so much for bringing some education to us that we haven't seen anywhere else, and for being so open about educating us, not selling from the stage, et cetera. People appreciate that.
That for me personally is the biggest reward. It really is. Just getting that general feedback that what you taught there, what you brought to the table, what you created, it made a difference in someone's life. It changed their life for the better. So I love that.
And I get that. We get that all the time. It's just that makes life worth living, doesn't it?
Absolutely it does. And so I want to talk to you about this 50-year stint that you've had in the real estate space. And if you knew what you knew today, back when you first bought the very first rental property out in California, what advice would you give yourself, Tom? You go back in time and give yourself some advice. What would it be?
Well, one, I would say that, you need to change your model periodically. Things change, markets changes. Our listeners remember, but back in the 80s, healthy food became popular. And there were a lot of steakhouses around that died. And there was one that was Sizzler that decided to add a salad bar and add chicken and fish to the menu, and they stayed alive. So I think you just need to keep watching the marketplace and keep learning. There are a lot of folks that believe that if something worked, it'll keep working forever, and you need to stay with it. And that's not necessarily the case just because it worked before. Mm-hmm. So I would say that keep changing your model, keep changing what you invest in, be alert, listen to podcasts like yours, and follow economists to see what's happening in the marketplace, and be willing to get outside your comfort zone, outside your pass box, and move into something new. And I'd say that was one of the things that worked. And one of the things that if I were going to do different, I would say I'd move faster.
Yep, I think that's always one of the common themes. Yep. I would have bought more, and I would have moved a lot faster. Or I would have bought commercial first, and I got my start in the bigger projects a lot sooner. So how about retail? I want to make a point regarding staying fresh and always be willing to adapt to the changing times. What are your thoughts on retail? I know that you're involved in some retail. Obviously, we've got the big behemoths of the world. Well, more so Amazon. They are the big behemoth. Walmart's, got a major e-commerce platform now as well. Ultimately, how do you think that affects the long-term relationship between shoppers and, the brick and mortar retail store? And does that concern you? Not necessarily today, but 10 to 15 years from now in the types of investments that you're in at this given point in time?
I think retail has gotten a bad rap. I think if you look at the Wall Street headlines, et cetera, everybody thinks that brick and mortar is all going to be scraped from the face of the earth in the next 5 years. And then you talk to them individually and say, do you think that's really going to happen? They're like, well, I guess not. But and you point out, by the way, you realize that the largest e-commerce company in the world has spent $13.7 million buying 460 brick and mortar stores.
On retail, yeah.
Yeah. Are you aware that Amazon now has brick and mortar bookstores again? Oh, really?
I was not aware of that, actually. That's new for me. I know that they're heavily invested in the retail brick and mortar format, but I did not know that it consisted of bookstores. So that's interesting.
We have one of those mixed use modern malls that's made to look like a old town in Italy here in Silicon Valley. And a few months ago, I was coming out of a movie with some friends and walking down the street, and there was a store that was pretty crowded. And I looked in, and what the heck is in there? And then I saw people holding books under their arm. And I back out in the street and I look up, says Amazon Books. Was this their plan all along? I don't know.
They're getting back to their roots.
And then I ask people, sure, a third of all the 900 malls in the United States will go dark. Another third, I think, will do just fine because they'll repurpose some of the space to entertainment and to service-oriented things.
Have you guys looked at any of those opportunities? I know there's a lot of shuttered malls across the country. I know that there's a lot of heavy emphasis on even adding like a multifamily component to some of those shuttered malls and revamping and reviving them. Have you guys looked at any projects along those lines?
We're doing well. We're doing probably $100 million worth of business this year of deal flow. But I think the mall is it's a little big at this stage for us to take on. Maybe downstream. I don't want it to be such a dominant piece of our business that if it goes sour, it takes everything down.
No, that's a great point.
So I think that's a little more risk than we want to take on. That's a real big gamble play. But at any rate, now I'll do a local retail strip mall. We don't call it retail anymore. We call it neighborhood service center to take that 4-letter word retail out of it. Because, you can think about it, you can't do your hair on the internet. You can't drink a beer with your friends on the internet. You can't get your dogs in, for inspect on get a vet to see them on the internet. So if it's service oriented, or even if it's an anchor store that has a large service sector, look at we own a power center in Amarillo, Texas, on the freeway. It gets 65,000 cars going by a day with eyeballs on it. One of them is a Burlington Coat Factory. Well, do people buy some clothes online? Yeah. Do most people like to go in and try it on and see if it fits and see how it feels? Yeah. If they buy something online, do they sometimes go to the store to pick it up? When they're there, they buy something else? Yep. Michael's, that's another one of the anchors at that power center that we have. Most artists like to see and touch the stuff they're getting.
Yeah. That's a good point.
So anyway, so I think some of that's common, kind of common sense. But when we go decide to buy something, we have two different aspects to look at. One is, do we think it's a good deal? And then number two, we have to also look at, do we think our client base will be comfortable with it? So you got both of those have to pass, right? Because even though we like it, we know it's a good deal. Maybe the clients are like, "Oh man, I just see too many headlines about retail, and I'm never going to put another dime in retail." So,
and your clients, meaning your investors, correct? Your limited partners,
correct? Yep.
Got it.
Yep. So anyway, I think retail gets a bad rap. We still like it, but we probably reluctant to do big box, not because we don't like it if you do sufficient vetting. I mean, we have a Fortune 500 CFO on retainer that goes and does deep dives for us when you've got important single tenants. So, that's the kind of thing as an individual, it's hard to do. You got to be big enough that you can afford to have those kinds of resources to bring in deep dives on the financials. But I think, retail service centers are still okay. Office buildings, but you got to know the submarket well. Is it on the right side of the street? So you do all the demographics about the growth in the area, how many rooftops are growing, and all of that. So we've done office buildings, especially like industrial. But industrial falls into two totally separate classes, just like office and other things. A single tenant deal is totally different than a multi-tenant deal. We just closed on a $26 million 103 tenant, 6 location portfolio of industrial in Houston. So that takes you're going to get better tenants, better quality credit, longer leases than you do in a multifam, but it's a little bit like a multifam, just higher quality. But you got to have a dedicated leasing team that's working on that all the time, just like you'd have an office manager in a multifam. Whereas a single tenant industrial is you're primarily buying the lease, right? So if you want to have a hold period of 5 years and you can find a property that's you can get a lease on it for 15 years, which is pretty typical for us. And you've done the deep dive and it looks like they're in a good market space and they're in good financial condition. They've been around for, 45 years and everything seems strong. And you're basically gambling on whether or not they go bankrupt. So if we think that chance is like down in the, 2-3% category, then I think that's pretty good. The irony of it is that most investors, if they invest in a syndication with someone that gives a kind of transparency and the amount of knowledge that we give on each deal, they know far more about that product than probably most things they've invested in their lives, including stock and the houses and so forth.
Sure. Very interesting. I'd love to ask you a few questions about this industrial facility that you guys has purchased here in Houston. I'm looking at it on your website now. So I believe you said 103 tenants. Yeah, there we go. 103 tenants, 19 total buildings. Yep. Near between the purchase price and the CapEx, $26 million. What excited you about that project there? I mean, is this a value add play? And if so, what does that value add component look like?
It was a stable property. However, the occupancy was below market. We made a couple test calls to the leasing agent and they didn't get back to us for a week. So we said, that's easy to fix. Fix that problem, things like that. So we love industrial. Feel like, do you like industrial better than multifam? Well, if they gave the same returns, I'd be equal. But right now, multifam, I'm selling a Class C in Fort Worth right now in a C neighborhood, a Class C property for a cap of 5.5.
That's unbelievable.
And we're giving preferred returns on this industrial complex of 9. So, in the end, they want returns. And this was able to spin off cash flow, right from the beginning. We love industrial. You minimize the risk by distributing it over a portfolio of multiple locations. None of them had any serious damage from the hurricane and flooding that happened down there. Houston is one of the economic powerhouses of growth in North America over the next 20 years. It's a fantastic market. We've got, because of the storm, what happens is when you have disasters, there's usually a drop in the economy for a brief period of time, for a few months. And then after that, then it actually has a boost because now you have to replace all the things that were damaged. You have all those different companies that migrate in to do the construction, and they need services from a lot of the tenants that are in this industrial complex. A lot of the buildings most of the buildings were in a very good condition and more modern buildings. We couldn't find anything not to like.
So you mentioned the market occupancy was low based on what you truly felt the market demand was. I mean, what was a market occupancy of that Northwest Houston area versus what this property was at when you took it over?
Market's 95 and 87 was what the property was sitting at.
Wow. Okay.
So it's it's still cash flowing. Just it gave us opportunity to give some value add. By the end of this hold period for this property, we expect it to be up at several $1 million. I think cap rates will be pretty strong. But I think we'll have we'll have the occupancy up to the market occupancy.
And what was the going in cap rate, if you recall, on this one?
7.5.
Okay. Wow.
Yep.
Fantastic.
But it was an off-market deal.
Yep. They're the best kind for the most part.
Yeah. And you can't get off-market deals if you're not heavily connected in the business. And you got
okay.
Yep.
Well, Tom, I'd like to switch gears a little bit. You've shared a lot of great information here today, lots of golden nuggets. But if you had just one final golden nugget of advice or wisdom that you could leave with our listeners here today that may inspire and motivate them as they progress in their real estate investing career, what would that one last final golden nugget be?
Can I give more than one?
You can give more than one. Absolutely. I love that. I like variety.
Well, one I said before, but it's worth repeating, I think, is that there's nothing more valuable than high integrity, high quality partners. Right? And I think we select partners like we select our employees. Number one is character, and number two is competence. Now, in the case of a co-syndicator, they got to have both, right? Because they got to have enough experience. They've got access to deal flow and so forth. But if we have 5 to pick from and have similar amount of competence and experience, we'll pick the one with the highest character. Mm-hmm. That works every time. 2, we always look at each deal. When you're picking a syndicator, you want to, again, look for those, of course, quality and character and track record and how genuine, transparent are they. We also want to make sure that you ask yourself, how did this particular asset class and this particular marketplace do during the crash? And is the deal look like it's strong enough that it can survive the next recession, and just assume that we will have another recession during the whole period? And then I say, lastly, I don't do any deal for which we would not be comfortable offering it to our family and friends. Mm-hmm. If anybody hesitates for 5 seconds, we're out of there. We're not going to do it. Mm-hmm. I don't need to be in this business. I do it because I love it. I love have a wonderful team that now is carrying this forward, and it's their careers. We have a lot of investors who now are partially dependent upon the products and deals we bring to them to contribute toward their early financial independence. And and I love the education component. I love sharing what I've learned with others, in case you can't tell that.
Yeah.
And then this BACOM, BACOMM.club, is doing just a fabulous job in that education arena as well. And and if I can mention my website for our Wilson Investment Properties is TomWilsonProperties.com, TomWilsonProperties.com. And on there's a lot of education information. There's all of the podcast broadcasts we've done for 6 years with some pretty remarkable folks like Bruce Norris and Dr. Doug Duncan and Robert Kiyosaki and Kim Kiyosaki and a lot of economists. We track economists very closely. I recommend that for folks. You can sign up to newsletters and so forth that provide that. We put it out every other week. But there's 6 economists that we follow closely. I just spent an hour of personal time with one of them after a big charity event down this past weekend in Southern Cal. And guess what? All 6 of these economists I follow have in common.
What's that?
They were of the select few of the economists in the country who predicted the last crash correctly before it happened, and for the right reason.
Okay. So what are they? What are they saying now?
I want to follow.
Collectively, what are they saying now at this point in time?
2 of the 6 think that we're going to crash bigger than before, because we really didn't have the financial crash. We had the credit bubble crash, and I think because of our high debt and high debt service and our debt to GDP ratio, that we've got more to come. The other 4 feel that we're strong enough, and we're the best looking horse outside the glue factory, and we therefore are going to, because of the relative basis in the marketplace, we're going to have a little bit more time on this ride. Anywhere from 2 to 3, maybe 4 years. The 2 that are pessimistic think we'll crash next year. So our job as listeners and students and so forth is to put all that together, and you got to make your own decision. Of course, the other thing to recognize is the market is thousands of submarkets. Yep. So depending on the asset class, what price of asset class, what market, what submarket, all of those have different cycles. So that's the other kind of golden nugget. I would say most of the data that's easy to get has information about the general marketplace, and it's a good place to start. But when you get down to submarkets, you really need an expert in that area, someone who's been there for a long time that knows about it. So again, just don't try to do it alone. Utilize all the expertise that you can out there. I know it's tough with all the data that's available. Sometimes the tough part is figuring out which ones to listen to. One way is to go with folks like you and me who are doing some of that filtering, and then provide what we think are the most important resources of information.
And on your website, Tom, do you actually have a newsletter? I mean, do you have a place where folks can sign up and get access to, articles or interviews or just general, comments that are made by these different economists that you follow, or any other, industry relative information that you're sharing? I mean, is it in the form of a newsletter or emails?
Indeed, we do. We put out we used to be weekly, and we thought maybe that was too much for people to handle because everybody gets so much information. So we've dropped it down to every 2 weeks. And there's also, we do a pretty extensive market update monthly for our BayCom show, and that is reposted on baycom.club as well as our TomWilsonProperties.com. So that's a nice summary of all the things that we pick out and we filter through that we think are important for the listener to be made aware of. And the other important thing for going on TomWilsonProperties.com is that if you sign up for that newsletter, then you now have access to syndication deals as they become available. We're launching a new one every 6 to 8 weeks. And most of the ones we do, we're highly regulated by this industry is highly regulated by the SEC. It's actually more stringent than a real estate board or IRS. SEC is very strong. All of our syndications are totally in compliance with all the SEC regulations. We have a great team of attorneys that make sure that everybody's protected. But the SEC, for most of our deals, only allows us to make these deals available to those that already have a connection with us. So it's very important if someone is interested in at least taking a look at and seeing what's available to sign up to a newsletter. That way you can get access. So
you do allow, I'm assuming, and so it's 506B, and you do allow some non-accredited investors.
Most of our deals allow non-accredited investors as well as accredited, and most of them are 506B. And occasionally we do a 506C, and frankly, the main reason we do it is because it just gives us the SEC authority to be able to do some general advertising client base. But we can raise most of our deals. We can raise pretty quickly with our own client base.
Yeah. Well, fantastic. Well, Tom, this has been an absolute pleasure. I really appreciate you taking the time to come on the show here. And actually, I just went on your website and I signed up for your newsletter and your updates. So I'm on your list now as well. So looking forward to staying in touch with you. And again, it's been an absolute pleasure having the show. And I suggested everyone that's listening, go get on his newsletter, sign up on his website, and spend some time on his website. You have a lot of great information there, a lot of great resources that you share, articles, and just give you a general idea and kind of put it together for you guys of who Tom is and the track record that we've spoken about here today. I guess the track record that we've just touched on very lightly here today. So, Tom, with that being said, I wish you the best with everything that you do here in the future moving forward. You've got a lot of great things going on, and thank you for giving back so graciously with your time and your knowledge to everyone here listening today, but as well as all the other folks that you touch on a regular basis. So with that being said, my friend, I look forward to next time.
Thank you, Kevin, so much. It's been a pleasure, and I really have enjoyed this, enjoyed sharing with you. You asked great questions. I look forward to our continuing relationship as well.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.